Hello, everyone. My name's John Lee, and I'm one of the distribution managers from the team here at Inova Asset Management. My colleague Rafio Khan joins me today, and together we help financial advisors around Australia deliver better investment outcomes for their clients and better operating leverage in their advice businesses. Before we talk about ethics, I want to start with a simple problem. Most models are built to create clarity. That's why advisors use them. They help organize uncertainty. They can help compare choices. And they help clients see what different paths might look like. But there is a risk. Sometimes, the clearer the model looks, the more certain the future can feel. And in advice, that matters, because clients don't always hear scenario. They hear future. They don't always hear assumption. They hear plan. And they don't always hear range. They'll hear promise. That gap between what the advisor means and what the client hears is precisely where ethical modelling lives. So this session isn't about whether modelling is useful. It is. The question is whether modelling is being used to improve client understanding, or whether it's accidentally making uncertain things look more settled than they really are. In today's session, we explore the idea of when models mislead and how advisors can use projections, portfolio logic, and goals-based conversations more ethically. So modelling supports professional judgment rather than quietly replacing it. I won't read the disclaimer line by line. The important point is this session is educational. We're using hypothetical modelling examples, public AFCA determinations, and ethical standards to explore professional judgment in advice. This isn't personal advice, it's not legal advice, and it's definitely not a product recommendation. Our focus today is judgment. How do we use modelling to help clients understand certainty without accidentally making uncertainty look cleaner than it really is? That's the lens for our entire session. We'll do this in two halves. I'll start with the ethical problem first. Why good advice can still look misleading. What AFCA keeps seeing. And the 3 tests of ethical modelling. Then my colleague Rafio will take the practical half. What makes a serious simulator different? How modelling can support better client conversations. And what advisors can do differently on Monday. So the journey ahead is simple. Human nature, real cases, grounded in an ethical framework. We'll take a look at some serious modelling and tie it all together with practical application. So let's start with the code. Standard 1 says act in accordance with the law and the code, and don't avoid or circumvent their intent. And I reckon this is where ethics gets very human. See, I've got young kids, and kids are brilliant at obeying the words while dodging the point. You say, don't throw Lego in the house, and they'll slide it across the floor and say, well, I didn't do it. Same mess, cleaner explanation. In advice, the adult version is subtler. It's a process that technically ticks the box but dodges the point. It's language that is literally true but still leaves the wrong impression. It's a model that looks balanced because the labels are doing the reassuring. The code isn't just fighting misconduct, it's fighting very normal human instincts. The instinct to rationalize, the instinct to frame, the instinct to find the neatest story for the thing we already want to believe or recommend. Standard 1 keeps us grounded and brings us back to substance. Standard 2 says act with integrity and in the best interests of each client. Again, there's a very human element at play here. You give 2 kids 1 biscuit, make one half slightly bigger, and someone's going to grab the bigger half immediately. Then the explanation arrives. And when I asked my older son Christopher why he didn't share with his little brother, his answer was actually brilliant. He said, Dad, I thought he wanted the smaller one because he's smaller. That is self-interest dressed up as fairness. Advisors don't usually do it in such an obvious way. We do it in more polished language. A switch becomes an opportunity. A speculative idea becomes conviction. A thin comparison becomes a strategic recommendation. None of these phrases are automatically wrong, but Standard 2 asks a harder question. Who is this really serving? Not, can I make this sound plausible? But does this genuinely serve this client with this life, these trade-offs, and these risks? Standard 3 is conflicts. Now in our house, the kids become elite negotiators at bedtime. They're suddenly thirsty, starving, philosophical, and deeply curious about dinosaurs. But what matters isn't just the excuse, it's the sequence. You see, the desired outcome comes first. Then the reasons assemble around it. Conflicted advice can work exactly like that. Not just obvious conflict and not just remuneration. Sometimes it's structural conflict, product availability, or even referral pathways. The desire to look decisive, the momentum that builds once a recommendation is already leaning one way. Once the momentum starts, every chart, comparison, and model can begin serving the idea instead of testing it. So Standard 3 is asking whether the client is being led down a narrow track that later gets explained as though it came from open-minded analysis. If the pathway is already pointing somewhere, the advisor has to prove the advice still points to the client. Standard 5 is where modelling becomes ethically charged. Advice has to be appropriate to the client's circumstances, and the advisor must have reasonable grounds to be satisfied the client understands the advice, the benefits, the costs, and the risks. That's a high bar. It's higher than a signature, higher than a nod, and it's definitely higher than sounds good. Disclosure is not comprehension. A client can look calm and still be confused. A client can like the picture and still miss the risk. And a client can hear the upside and not grasp the trade-off fully. This matters when modelling enters the room because elegant output can create a false sense that understanding has happened simply because the material looks clear. Well, it hasn't. Could the client explain it back in plain English? What has to be true for this to work? What could disappoint them? And what are they giving up by staying where they are? If they can't explain the trade-off, we don't have understanding yet. We have presentation. Standard 6 asks us to think beyond the immediate meeting. What are the broad effects of the client acting on the advice? Not just this week, not just the next review, the broader, longer-term position. Something can feel reassuring today and still set the client up badly later. A more complex structure can feel empowering now and exhausting later. A concentrated strategy can feel exciting now, but reckless later. And a product with poor liquidity can look manageable in good conditions, but very quickly become a trap at the wrong time. Standard 6 pushes us forward in time. What happens if assumptions disappoint? What happens if retirement timing changes? And what happens if the client needs access, flexibility, simplicity, or just a good night's sleep? Good modelling should widen foresight. It should help the client and the advisor see further, not just feel better. So that's the code. Now bringing it into the advice room, the first ethical risk is simple. The client leaves more certain than they should be. That happens very easily. A model gives numbers, a chart gives shape, a report gives neatness. And a probability range can look so professional that uncertainty starts feeling handled. But uncertainty isn't handled just because it's been formatted nicely. A client may still walk out thinking, we've got a plan, so we're sorted. That is exactly where modelling can mislead without anyone meaning to mislead. Second, the recommendation can look more tailored than it really is. This is where presentation becomes persuasive. We personalize the inputs, we use the client's goals, we show a tidy pathway that seems to line up perfectly with what they want. None of that is bad per se. The problem is that bespoke presentation can create the feeling of bespoke reasoning. Those are not always the same thing. A recommendation can feel deeply personalized, while the underlying logic is still generic, product-led, or just way too thin. Third, the advice can look stronger than the underlying reasoning deserves. Once you have certainty on one side and apparent tailoring on the other, the recommendation starts to feel sturdier than it may actually be. A polished comparison, a clean projection, a growth pathway with sensible labels. Suddenly, the recommendation feels earned. But what if the evidence base is weak? What if alternatives weren't properly tested? And what if the fit depends on generous assumptions? Put the three risks together and you get the ethical pattern. False confidence, false fit, false strength. Modelling isn't bad, it's powerful. And with great power comes great responsibility. In advice, anything this powerful can either support judgment or quietly outrun it. So here's a dilemma. Client modelling can clarify outcomes or camouflage weak advice. A model can smooth over weak fit. It can mask real risks. It can overstate diversification. And it can make a switch look justified before the hard work has actually been done. That doesn't make modelling unethical. It's just the question shouldn't be, does the chart look good? The ethical question is, does the confidence generated by the model match the strength of the reasoning underneath? If the model's doing more persuasive work than the evidence deserves, that is where advisors drift into trouble. And the danger isn't usually bad faith. The danger is that everyone in the room starts borrowing confidence from how the data is presented. Let's make this concrete with our first AFCA file. Broadly, this was a superannuation pathway built around moving the clients into Shield through a new structure. On the surface, that kind of advice can sound coherent. It sounds like more control, wider choice, better long-term outcomes, and a serious-looking pathway. But AFCA found something more troubling underneath: the danger of plausibility. And that's why this case is so useful. The advice didn't need to sound reckless to become ethically dangerous. It only needed to sound coherent enough that the client could borrow confidence from the story. As we move through the next few slides, I want you guys to watch the gap between label and underlying structure. A product story, category, chart, or advice pathway can make weak fit feel more solid than it really is. The issue isn't just product, it's what the story made easier to believe. Starting with the diversification story. Shield was described as diversified or multi-manager, but AFCA noted only 2 managers were used. That matters because labels do a huge amount of emotional work in advice. A client hears diversified and they think spread. They hear multi-manager and they think breadth, independence, and risk control. But a label is not the same as the underlying reality. If the underlying structure doesn't justify that level of comfort, the label has already done too much work. And once the label has done its job, the advisor can begin sounding more prudent than the portfolio really is. Then there's the property exposure. AFCA found the fund was overexposed to property. Again, this isn't to make a technical investment point. The ethical issue is what the client is likely to understand from the framing. If the story says diversified growth, but the structure says concentrated or high-risk property exposure, the client isn't being helped to see uncertainty clearly. They're being given a cleaner story than the underlying asset mix deserves. So the takeaway for advisors here is the risk reality matters more than the comfort created by the presentation. Then we get role confusion. AFCA noted the product was intended as a satellite investment, but it was effectively used as a core recommendation. That isn't a tiny wording problem. Satellite and core tell the client what job the investment is doing in their life. Satellite means supporting position, limited dependence, controlled role. Core means the outcome now heavily leans on it. So when something intended to be satellite is used like a core, the risk profile of the advice changes. The client isn't just buying an investment. They're buying an idea about how much of their future rests on that investment doing what the story says. Because when that role quietly shifts, suitability and comprehension shift with it. Then AFCA widened the lens. Key product and structure risks were not dealt with properly. And here's what I found particularly interesting from this case. The story got stronger, but the client's actual understanding did not. Labels, charts, and categories, they can create more confidence than the underlying structure deserves. And once that happens, weak advice can sound perfectly reasonable. Because the presentation has started carrying more weight than the substance. That's the professional risk. It's that advisors must constantly ask, is this presentation clarifying the client's understanding, or is it making the recommendation easier to accept than it deserves? The next case file changes the angle. This one's less about a misleading product story and more about a narrowing advice process. Broadly, the client was advised to move from one superannuation wrap platform to another so he could access Shield. On the surface, that can sound professional. Better platform, better access, better growth path. But AFCA's real question sat underneath the apparent orderliness of the recommendation. Was the pathway genuinely open, or had it narrowed too early? And that's where standards 3, 5, and 6 all come alive. Standard 3, was the process free of steering, or was the destination already doing the work? Standard 5, did the client understand the alternatives, costs, benefits, and risks? Standard 6, after implementation, was the client actually better off or simply more exposed? So as we move through the next few slides, watch how these standards appear and reappear. And AFCA found the rollover was recommended so the client could access Shield. That's the narrowing moment. Because once the key rationale for changing platform is access to one particular product, optionality is already shrinking. AFCA found the comparisons of the underlying investments weren't evident. That matters because the underlying investments would have the greater impact on performance and risk. So this is a process problem before it's even become an outcome problem. If alternatives are not genuinely tested at the level that matters, the client isn't choosing from an open field. They're being guided down a corridor, and a corridor can still feel very orderly while staying much narrower than it looks. Then AFCA looked at the evidence base. The advice relied on weak evidence and unreliable performance data to support the platform benefit. That is one of the clearest warning signs in advice. Strong presentation, paper thin proof. AFCA also looked at the purported platform benefits and found several weren't relevant, of no real benefit, or not properly connected to the actual recommendation. That's the danger. Something can be listed as a benefit and still have almost no practical relevance to the client's actual strategy. Weak evidence is often hidden by strong presentation. Then the outcome. AFCA found the client was left materially riskier and worse off, with compensation ordered around $274,000. The number matters, but the professional lesson matters more. This wasn't just a wording issue, and it wasn't just a process complaint, and it's not just about paperwork. The client was left worse off in a measurable way. That strips away the temptation to treat this as theoretical. A plausible story can still create real harm. And that's why the ethical discipline matters before the outcome is known. Because by the time the loss calculation is needed, the advice process has already failed. Now freeze a story at the surface level. Better returns, better platform, suitable growth path. In the room, those words sounded organized. They sound like progress. It sounds like somebody's done the hard work. And it sounds like a professional guiding the client toward a more purposeful strategy. The point I'm trying to make here is weak advice rarely sounds weak while it's being presented. It usually sounds helpful, sounds diligent, and it usually sounds confident. That's why advisors have to separate persuasive language from earned logic. Because if the story sounds strong before the comparison is robust, the client may be responding to the confidence of the presentation rather than the quality of the reasoning. Then AFCA's findings sit underneath that polished surface. Poor checks, weak data set, no real benefit or gain. Wrong risk fit. The contrast is a stark reminder that the client heard a coherent story of improvement, but AFCA found a much weaker foundation underneath. It's a case of the story sounding better than the logic. And that's the warning bell for ethical modelling. If the recommendation is becoming easier to believe than the evidence underneath can justify, stop. Slow it down. Reopen the pathway. Test the trade-offs again. And this is where we stop treating these as isolated cases. Different fact sets, yes, but if you zoom out, you might notice a familiar shape emerge. Take the switch, for example. A client is moved toward a cleaner looking solution, but the comparison is thin and the performance basis unreliable. Reduced optionality starts early. Then the file tries to justify the move after the real choice is already narrowed. The platform change sounds like progress, but the evidence base said otherwise. Then the SMSF, more structure, more moving parts, more apparent control. But underneath, AFCA found high concentration risk and a misleading pathway. The structure looked sophisticated, but the client's real margin for error was getting smaller, not larger. That's why this pattern catches advisors out. Complexity can feel like diligence. It can look like care. But if the structure mainly exists to facilitate the product, the sophistication is mostly cosmetic. The narrow path, another rollover story, another pathway that narrows too early. The issue was not only concentration and risk, it was that real alternatives analysis never properly opened up. And risk suitability had to be stretched to make the pathway work. The pathway narrows, justification catches up behind it, and the client is left carrying more risk than the story suggested. And then the Interprac lead decision update. Different firm, same geometry. Inadequate inquiries, lower risk alternatives not properly considered. AFCA's concern here was that the advisor had not properly considered whether existing or alternative superannuation options could meet the client's needs with lower risk, fees, and cost. It's the same design flaw, and once you zoom out, this stops being about one fund, one platform, or even one unlucky file. It becomes a professional pattern. Reduced optionality, justified later, worsened outcomes. Those are the caution signs to look for whenever a recommendation feels too complete too early. The corridor narrows, the explanation thickens, the client ends up carrying more risk, complexity, or loss than they reasonably needed to. The mirage of certainty brings us back to modelling. Advisors see assumptions and ranges, while clients may hear certainty and reassurance. That gap is where ethical modelling lives. Because when an advisor looks at a projection, they see the machinery, assumptions, inputs, sensitivity, what could change the result, what's doing the heavy lifting. Clients don't always hear that. Sometimes they'll hear, "You'll probably be okay," or "This looks sorted." Sometimes they hear permission to relax. That's the mirage. Not that the numbers are fake, but that the human meaning taken from the numbers can become much firmer than the evidence underneath. Ethical modelling makes uncertainty visible. It shows the range, not just the midpoint, what has to be true and what could go wrong. It shows what staying put might look like as well. Good modelling should make humility easier, not harder. So here's the practical framework. 3 tests of ethical modelling: understanding, fit, and fairness. 3 tests with one purpose: use modelling to improve judgment, not just presentation. Now, I like frameworks that are simple enough to remember on the fly, so if you're like me, you might find this handy too. It goes like this. 1, if modelling passes all 3 tests, it's much more likely to be helping the client think. If it fails one of them, the model may still look polished, but it's starting to lean towards persuasion rather than professional clarity. So as Rafio picks this up in the practical half, keep this frame in mind. It's not about whether the tool or the charts look impressive. It's whether the use of it is ethically sound. First, the understanding test. Disclosure is not comprehension. Good modelling should translate risk and uncertainty into plain English. And we've got a simple checklist here: the advice, the benefits, the costs, and the risks. Could the client explain those 4 things back to us without borrowing our language? And could they tell us what the upside and the catches are? What has to happen for the strategy to work well, or what might make it disappoint? And could they explain why this pathway was chosen over staying where they were or taking a different route? That is the real test. It's not whether the disclosure was provided, but whether the meaning actually landed. Now, plenty of clients can repeat the hopeful bit. Fewer can explain the trade-off. And if they can't explain the trade-off, they're not yet making an informed decision. They're mirroring the advisor's confidence. Second, the fit test. A risk score is not a life plan, and modelling should improve suitability. Real fit often depends on goals, time horizon, risk capacity, and trade-offs. That matters because advice can look suitable on paper while still being poorly fitted to the life the client is actually trying to live. A risk questionnaire might say high growth or conservative. Fine, but what's the money for? And when's it needed? How flexible does the strategy need to be? And how much complexity can the client realistically carry? And what happens if returns arrive in the wrong order? You see, fit is broader than score, and it's broader than product categories or labels. True fit asks whether the recommendation genuinely belongs in the client's life. And third, we have the fairness test. Fair modelling slows down a predetermined pathway. That is its job. It helps clients understand choices. It shows trade-offs. It avoids steering, and it lets the logic stand on its own 2 feet. And this is where advisors can pressure test their own thinking. Are we modelling only the recommended strategy? Or are we also showing what the client's life might look like if they stayed where they are or chose an alternative option? Are we presenting the recommendation as though it emerged from fair comparison? Or are we quietly guiding the conversation so the model does the selling for us? Fair modelling means showing choices and trade-offs, not steering clients and letting the logic stand. And another practical test you guys can try out, ask yourselves, if the model disappeared from the meeting, would the recommendation still feel as strong? If not, slow it down. And that brings us to the standard we're aiming for, modeling without misleading. How can we tell the client's story by showing what life could look like with your advice and without it? That kind of modeling doesn't weaken advice or hurt your credibility. It strengthens trust, demonstrates integrity, and shows you genuinely care. Because it keeps uncertainty in the room where it belongs. It doesn't pretend the future has become tidy or predictable. It helps the client see the trade-offs more honestly. And when clients can see the trade-offs more honestly, their consent is better, their understanding is better, and the advice is more likely to stand up as professional judgment rather than polished persuasion, or worse yet, intellectual dishonesty. Now, my colleague Rafio Khan is going to pick it up from here and is going to show us what serious modeling looks like beneath the surface and how we can start using it professionally in practice. Thanks again, everyone.
Thanks, John. So John has set up the ethical problem really clearly. Somewhere right now, there is a retirement projection running on a spreadsheet built by someone who left the firm 4 years ago. It has a tab called Do Not Touch. The assumed return is 8%. Nobody's questioned it since 2019. And every week, clients are nodding at that output and making the biggest financial decisions of their lives. That spreadsheet and what we owe the people relying on it is exactly why we're here. My section is about what better modeling looks like in practice. Not modeling as a sales tool, not modeling as a prediction machine, and not modeling as a way to make the recommendation look more polished. The role of good modeling is to show the client the trade-off. What life could look like with your advice. What life could look like without your advice. And then, what might happen if the path is better, worse, or just different from what everyone hoped. So I'm going to move from John's ethical framework into the practical side. How do we show uncertainty? How do we explain it in plain English? And how do we use modeling to support better advice conversations? This is the roadmap for the second half. We'll start with show, not tell. That means we do not just tell a client a strategy that is suitable. We show what the strategy could mean over time. Then we'll move into plain talk, because technical modeling only helps if the client can actually understand the trade-off. Then we'll walk through Helen, a fictional case study. Helen is important because she shows that advice value is not just investment selection. The real value often comes from strategy, structure, contribution planning, retirement timing, and better client dialogue. After that, we'll connect this back to defensibility and some of the other real-world case themes that John introduced. Then we'll finish with advice outcomes and 6 practical checks you can take away to try next week. So the shift now is from ethical risk to practical application. The first principle is show, not tell. A lot of projections mislead because they are too smooth. That does not mean the maths is always wrong. It means the picture can be too clean. Straight line projections are easy to read, but they hide the parts that clients actually experience. The discomfort of staying invested when the path looks ugly. So when we talk about a quantitative backbone, we are not saying that the model can predict the future. We are saying the model should communicate uncertainty more honestly. There are 3 starting points here. First, forward return forecasts. Starting with forward-looking return assumptions, because we are not just dragging the past into the future. The point is to not predict perfectly. It is to set a disciplined starting point for plausible future outcomes. Second, historical return series. We use historical return patterns to keep the modeling grounded in real market behavior. Not because history repeats neatly, but because it shows the kind of volatility, sequencing, and discomfort clients may actually experience. Third, block bootstrap. Block bootstrap matters because the markets do not move one day at a time in isolation. Good and bad periods cluster, and this helps preserve the shape of real market sequences instead of smoothing them into something too clean. That is the first layer. The model needs enough structure to be disciplined, but enough humility to show uncertainty. Then we add the next layer, Z-score standardization. This puts different asset classes onto a comparable scale, so the model can combine return patterns more consistently rather than letting one noisy series dominate the output unfairly. For example, if you were to sit two exam papers, maths and English, and you scored 72 in both, that number 72 in isolation means very little. It just means 72 out of 100. But if we add some context to it, if the average in English was 50, then you would have scored above the average. And if the average in maths was 85, then you would have scored below the average. Z-score standardization helps us compare two different outcomes on a more like-for-like scale. Then Monte Carlo. Monte Carlo lets us generate many possible paths rather than one neat line. That is important ethically because clients need to see there are multiple plausible futures, not one forecast pretending to be destined. And then we show 100 wealth paths. The 100 wealth paths make uncertainty visible. We are not saying any one path will happen. We are showing the client the range of journeys their money could take, including uncomfortable paths that a straight line projection would hide. That is really the point of this section. The goal is not to predict the future. The goal is to stop pretending there is only one future. Because once a client sees the range, the conversation changes. You are no longer just saying, this strategy should work. You can say, here is the good path, the average path, the bad path, and this is what cash may look like. Here is where the strategy could disappoint, and here is the trade-off you are actually making. That is much closer to ethical modeling. The second principle is plain talk. The maths matters, but it only earns its place if the client can understand what it means. This is where modeling improves the conversation. Instead of talking abstractly about risk profiles, asset allocation, or product labels, we can show how different ideas fit with the client's actual goal. That is the key shift here. Not this portfolio has this label, not this strategy has this expected return, and definitely not this is the recommended option. But what does this mean for the client's life? Does it improve their chances of meeting their income goal? Does it create more downside risk than they are comfortable with? Does it give them enough flexibility? Does it improve their runway? Does it create a trade-off they may not have understood? Professional judgment is the balance between client preference, risk capacity, and long-term consequence. A model should help that judgment. It should not replace it. This chart is a 10-year short-term simulation for a 40-year-old accumulator. The chart shows the cash benchmark, which is the dotted line, the good outcome, which is the green line, and the average path, the blue line, and the bad scenario, which is the red line. We'll be using this structure going forward for the next few scenarios. Let's make this practical. Helen is a fictional client. She is 61. We are not trying to find one perfect answer here. We are trying to show how modeling can help an advisor and their client compare different pathways in a more thoughtful way. And the main point is not investments. It is not whether one portfolio mix beats another portfolio mix. The point is that the strategic advice and thoughtful client dialogue can add much more value than a narrow investment conversation. Helen shows us that. As mentioned, she is 61, she is a senior public servant, and has around $920,000 invested. She is planning to retire at 65 with concessional contributions about $16,000 per year. Helen is also recently widowed. Maybe she's become much more defensive after losing her husband and seeing news about market volatility. So we want to be clear about the biases and the mental roadblocks that she may be considering. That reaction is understandable. The advice question is whether it still fits the life she wants to fund. And this context matters because Helen is not just a portfolio or an account balance. She is close to retirement. So we have sequencing and longevity risks. She has recently gone through a major life event, and she does not have unlimited time to recover from poor decisions. So the modeling has to respect both sides, the financial side and the human side. And this is where advice becomes more than just choosing an investment option. Now we add Helen's goals. She wants retirement income of around $70,000 per year, splitting her essential spending and discretionary spending into the amounts shown. And she may also want to leave something behind for her daughter or grandchildren. And she plans to downsize at 66 and move in with her daughter with a potential equity release of about $350,000 in 5 years. The key issue here is Helen sees herself as a conservative risk profile. Given the emotional trauma of losing her husband, it makes sense that Helen's current mindset could be influenced by loss aversion or other biases. Naturally, she might come into your office saying, "I just want stability," or "I want to avoid getting it wrong." As such, let's assume Helen thinks the smarter move is to leave her downsizer in cash, for example, a savings account, rather than reinvesting it as non-concessional downsizer contributions after she sells. And that word conservative matters, but it is not the whole answer. It could mean she hates losses, or she wants stability, or it could mean she does not understand risk. Or it could mean that after losing her spouse, she does not want any more uncertainty, perceived or otherwise. So the advisor's job is to not override her preference, but it is also not to accept the label and stop thinking. The real question is, what path best balances Helen's comfort, income goal, and downside risk, longevity, and capacity to take measured long-term risk? That is what the modeling is designed to explore. We are going to compare 3 ways Helen's plan could be built. Each path solves a different problem and creates a different risk. The first is the current path. This is the clean baseline. No advice overlay, no contribution uplift, no bucketing, no downsizing strategy, just Helen's current trajectory if nothing changes. The second is client-led buckets. This starts with Helen's comfort level. It gives her more structure, increases concessional contributions, and moves her into a moderate investment mix. The third is capacity-led buckets. This looks more deeply at Helen's risk capacity, not just her risk comfort. It uses a more growth-oriented bucket structure, maximizes concessional contributions, and reinvests downsized equity into super as a non-concessional contribution, assuming Helen qualifies. We are not saying there is one correct answer. We are showing how different advice conversations create different futures. Before we compare the outcomes, one important point: the underlying return assumptions are held constant, and advisors can change and customize these if they disagree with the return assumptions. We are not changing the engine each time to manufacture a better chart. The assumptions stay the same. What changes is the advice strategy, which includes contribution levels, bucket structure, time horizon, risk capacity, and whether downsized equity is used. That is the point of Helen. Thoughtful advice can change the client's trajectory without pretending we know the future. So when we compare these pathways, we are not saying the model knows what will happen. We are saying the model helps us show the consequences of different choices. This is Helen's current path. This is the quote-unquote without advice baseline. She remains 100% invested in a single multi-asset conservative portfolio. No other strategic changes are made. We are not criticizing the existing portfolio. We are showing Helen's current trajectory if nothing changes. This path gives her the most emotional comfort. It is simple, familiar, and aligned with how she sees herself. This is Helen's current scenario. The chart shows the good scenario, average, and bad compared to the cash benchmark. But the modeling shows the trade-off. It gives her the least runway. The mix is conservative, around 70-30, and her median longevity is around 82. And the average balance at age 75 is just over $500,000. The advice question is not, quote-unquote, is conservative wrong? The question is, however, does this path give Helen enough confidence that her income goal can be sustained? This slide compares Helen's current path to the cash benchmark. The average balance at 75 remains around $500,000, and the point here is to not say that cash is bad. Cash can feel safe, but cash creates its own risk. The risk that money does not last as long as life needs it to support. The current conservative pathway may look better than cash in many scenarios, but it still does not give Helen the runway she needs. That benchmark helps Helen understand that safe depends on what risk we mean. Market risk is one risk, longevity risk is another, and inflation risk is another. Now we move to path 2, client-led buckets. This pathway starts with Helen's preference, as she sees herself as a conservative, so we do not dismiss that. Instead, we build structure around it. The model uses 3 buckets. The safety bucket covers the short term, roughly 6 years. The lifestyle bucket covers the medium term, 6 to 10 years, and the future bucket, which covers the long term, 10 years plus. The allocation is 60, 35, and 5. So 60% short term, 35% medium term, and 5% long term. We also model maximizing concessional contributions to $30,000 per annum. And we move to a more moderate investment mix, 50-50. That is not a radical change. It respects Helen's comfort, but adds more discipline around time horizon, contributions, and sustainability. Now we see the modeled effect. The client-led bucket approach gives Helen more structure and some uplift. The mix is moderate, around 50-50, and median longevity improves to around age 83. And the average balance at age 75 improves to about $688,000. That is meaningful, but the lesson is not simply more growth assets equal better outcome. That is too simplistic. The real lesson is that the strategy has changed. We have added bucket structure, matched parts of the portfolio to time horizons, increased concessional contributions, and created a more deliberate conversation around Helen's goal. The investments matter, but they are not the whole story. The advice structure is doing a lot of the work. Here we compare the client-led bucket strategy against the cash benchmark. The average scenario looks stronger. The runway improves. Average balance at age 75 remains around $688,000. But the model does not improve uncertainty. There is still a range, a downside path, and a trade-off that Helen needs to understand. So we should not say, "Hey Helen, this fixes the problem." The better explanation is, "This pathway may improve your retirement position, but it changes the trade-off. There is more structure, contribution discipline, growth exposure, and runway, but also more market movement than her current conservative path." Now we put the current path and the client-led buckets side by side. This is where the model becomes useful for dialogue. Helen can see the client-led approach improves the average outcome. At age 75, balance moves from around 535,000 to around 688,000. And median longevity improves by around 2 years. Now that is useful, but is not a complete solution. It does not solve every problem, and this is where a good advisor slows the conversation down. They might say, "Helen, this gives you more structure and improves the modeled outcome, but it still leaves some pressure later. Are you comfortable exploring whether your actual risk capacity may be higher than your initial risk comfort?" That is a better conversation than jumping straight to product recommendation. Now we move to the third pathway, capacity-led buckets. This is where the advice conversation goes deeper. We still maximize the concessional contributions to 30,000 per annum. We also model Helen's downsizing proceeds, around 350,000 being contributed into super as a non-concessional contribution, assuming she qualifies. And the bucket allocation changes materially. Instead of 60-35-5, this pathway uses 25-30-45. So less in the short-term safety bucket and more capital allocated to medium and long-term needs. The investment mix is now balanced, around 33% defensive and 67% growth. This is not about ignoring Helen's conservative preference. It is about separating risk comfort from risk capacity. So Helen may feel conservative, but her financial position may give her more capacity to take measured long-term risk than she initially thinks. That is not a product conversation, that is strategic advice. Now we see the capacity-led scenario. This pathway is led by risk capacity. It is designed to fit more directly with Helen's long-term goal. Using a balanced mix, the median longevity is about 90 plus, with the average balance at age 75 around 1.5 million. That is a very different outcome. But the explanation matters. The conclusion isn't balanced is better than conservative. That misses the entire point. When the advice conversation includes contributions, downsizing, bucket structure, time horizon, and risk capacity, the client's trajectory can change significantly. Their investment mix is only one part. The bigger value is strategic. Helen can now compare current comfort, client-led structure, and the capacity-led structure. This compares the capacity-led bucket strategy to cash. The difference is clear visually. Cash runs down. The capacity-led average scenario creates a much stronger runway. But we still avoid overclaiming. This is a model, and it's based on assumptions, and it is hypothetical. Actual outcomes will differ. The ethical value is not that we can promise Helen this result. The ethical value is that Helen can see how much the strategy matters. Contributions, downsizing, buckets, time horizon, risk capacity, and use of capital. That is where modeling supports better advice. Comparing the current path, client-led buckets, capacity-led buckets, the three pathways we talked about initially. Same client, different advice choices, different consequences. The current path is most comfortable but has the least runway. The client-led bucket strategy improves the outcome by adding structure, contributions, and moderate investment alignment. And the capacity-led strategy is much stronger because it uses Helen's broader financial position. It factors downsizing, it aligns more capital to long-term needs, and it better matches investment risk to her risk capacity, not just her initial risk label. Average balance at age 75 is around 1.49 million in the capacity-led scenario, almost $1 million higher than the current path. But if this becomes a conversation about conservative versus balanced, we've missed the entire point. Helen is about the strategic advice, the contributions, buckets, downsizing, risk capacity, and client understanding. This is what really matters. Now let's compare the pathways. Current path. Median balance at age 90 is 0. Goal probability, 0%. That sounds blunt, but it is useful. The point is not to scare Helen. The point is to show that comfort today may not sustain the goal later. Clients often define risk as market movement. But for Helen, another major risk is not having enough runway. The model brings that risk into the room. Then we add client-led buckets. Again, median balance at age 90 is shown as 0. Goal probability is still 0%. That is useful because it prevents overselling the improvement. Yes, the client-led pathway improves age 75 balance and median longevity, but it still may not fully support the goal to age 90. Better is not always enough. This is why advisors need to test deeper capacity, not just make the current preference more structured. Now we add the capacity-led pathway. Median balance at age 90, around 800,000. Goal probability, around 95%. This is a step change. But again, this should be explained carefully. We are not saying this is the answer for every Helen. We are saying this is what becomes visible when advice conversation expands. The current path asks, what is Helen comfortable with? The client-led path asks, how do we structure around that comfort? And the capacity-led path asks, what is Helen genuinely capable of doing if we explain the trade-offs properly? That third question is where advice can add significant value. Now we move from modeling the conversation to recording the conversation. Good modeling is not just what happens on screen, but it also gets captured. What was shown? What trade-offs were discussed? What options were provided? What assumptions were highlighted? Those notes matter later. They support professionalism, they support defensibility, and they create evidence of best interest reasoning. If the advice is ever questioned, the question will not be, what did the model show? It will be, why was this pathway selected? What alternatives were considered? What did the client understand? Were the assumptions explained? Better modeling should leave a better record of what was shown, weighed up, and explained. A strong file note should make the reasoning visible, not just the result. Now let's connect this back to AFCA reporting. The first guardian and shield matters are a reminder that switching analysis needs proper care. A model can inform a switch analysis, but it cannot justify a switch on its own. This is the switch warning. We've highlighted 3 issues from this case: inadequate inquiry into the client's circumstances, limited explanation of high-risk investments, and the benefit of switching not being demonstrated given the fees. AFCA's Interprac-led decision similarly focused on reasonable inquiries, whether the advice was appropriate and whether existing or lower risk alternatives were properly considered. So the practical lesson is simple. If a client is being moved from one structure to another, the model must not only be the proof, but you also need advice logic. Why switch? Why now? Why this platform? Why this pathway? What alternatives were considered? And what if the client stays where they are? This is what makes the switch analysis professional. Now we bring it back to advice outcomes. This is the standard. Good modeling should help deliver advice that is clear, fair, understood, and promotes stronger professional standards. That means client preferences are documented, not just a risk score. What matters to the client? What worries them? What are they trying to protect? What are they willing to trade off? Second, implications are disclosed and optionality is provided. The client sees alternatives, not just the recommended pathway. Third, the advice and recommendations align to the client's objectives, not the model's neatest output, the client's objectives. And fourth, the client understands the advice well enough to decide confidently. That is the real test. Not whether the chart is impressive, but whether the client understands what it means, what could go wrong, and why this path was recommended over the alternatives. Now let's make this practical. What should advisors do differently in their conversations? Before showing a model and before relying on a simulator, there are 6 useful questions to ask. What might this client wrongly assume from this output? They may hear certainty where the advisor sees assumptions. They may see an average scenario and think this is the expected future. What trade-off am I not making explicit enough? Every model simplifies something. So what is being hidden by the neatness? Is it downside? Is it liquidity? Is it volatility or complexity? Would this recommendation stand if the model disappeared? That is a useful pressure test. If the advice only feels strong while the chart is on screen, the logic may not be strong enough. Good modeling should support the recommendation. It should not carry it. Before relying on a simulator, ask 3 more questions. Am I using it to explain or to persuade? This is the ethical dividing line. Am I showing a range or just a neat story? If the model only shows the tidy version, it may create comfort without comprehension. And have I considered the client's broader long-term interests and likely circumstances? This brings us back to the code. The client is not just a risk profile. They have goals, time horizons, family circumstances, income needs, liquidity needs, emotional constraints, and future uncertainty. Doing this ensures we're using client modeling to create more ethical advice outcomes and lift up professional standards. A serious simulator should help the advisor think more deeply. It should not narrow the pathway too early. So let's close the loop. Ethical modeling is not about finding certainty. It is about helping clients make better informed decisions under uncertainty. John showed how modeling can mislead when story becomes stronger than the logic. We have looked at how better modeling can make range, downside, and trade-offs more visible. And Helen showed that the value of advice is not just investment selection. It is strategy, contribution planning, bucket design, use of capital, risk capacity, and client understanding. That is the real role of modeling. Not to tell the client the future, but to help them understand the decision they are making. We'll finish here. The QR code lets you download today's slides and preview the Goal Simulator. Use that as a follow-up resource. The main message I would leave you with is this. Modeling should not make uncertainty disappear. It should make uncertainty easier to discuss. And when it is used well, it helps advisors have clearer, fairer, and more professional conversations with clients. Thanks, everyone.